and 55 pence sterling.
For more on finance, we're joined in the studio now by Rod North from Bourse Communications. Rod, good morning.
Good morning.
So we've got the RBA meeting.
Yes, we've got the RBA meeting. We're not expecting much to happen today. I think it will really be the commentary we get from the RBA on Friday that people will be looking to. But I think it's quite interesting in that it's now sort of 12 months since we saw the cash rate drop from 2.75 to 2.5. But interesting in the context of when we go back to even 2011, when the rate was 4.75. But the thing that frightened me a little bit was I look back to 2008 when the cash rate was 7.25%. And I'm thinking, well, we're at 2.5 at the moment. There's still a bit of talk at some point that there is a chance that the cash rate could come down a little bit at some point, depending on what happens with the outlook for employment and also business consumer confidence and a range of other data that we expect to get over the next few days. But the concern, I suppose, is you wouldn't want to see the cash rate over the next few years ratchet back up into that 4% or that 7% level. It concerns me particularly with the amount of money that's been in the property and housing sector as well, you know, where people are gearing themselves up, you know, for property. I think that could be a bit of a concern.
A very important point, because what goes down can go up, and there are lots of highly leveraged people with monster mortgages, especially in cities like Sydney and Melbourne, who could be in some trouble if there's a big increase in rates. Not immediately, of course, but over the next few years.
So I think that's why it's sort of good in history just to look back a little bit and just see where we were and where we are now, because I think we've been sort of lulled into a false sense of we haven't seen you know, rates like this for sort of 50 years, and take advantage of them, really pay off as much as you can, I think, really.
Now, retail spending for June is looking all right?
The figures came out for June, an increase of 0.6, which was a good result. Most market economists are expecting about 0.3 or 0.4, but just we can't forget the fact that it is June, and there have been an incredible amount of sales going on during that period of time. So I think the thing that I'll be really looking for is to see what a lot of the listed retail companies will be announcing when they come out with their full year results over coming weeks, now that we're in the midst of the reporting season. Did concern me a little bit that a number of companies have actually put profit warnings out already, like Kathmandu and Bonds and a couple of other companies. So that's a concern. And also it was interesting that after all the sales, Myer announced yesterday that they've got another $50 million sale happening. So I'd expect you probably see David Jones might follow with that as well. So there's still plenty of stock around, and I don't know about you, but I've been in the city a couple of weekends and noticed the queues have certainly been out the front of H&M, but you could fire a cannon through Myer and David Jones.
It's still a very tough environment for a lot of retailers, especially big retailers. Just very quickly before we go, we've got the jobless figures out on Thursday. What are they expecting to show?
Look, I think there's a bit of expectation that the rate sort of might ratchet up to around 6%. There is some concern sort of over that. But again, at the end of the day, I mean, one of the key things I watch is the participation rate, and we just need to get a lot more people out there in business, getting a lot more confident and realising that the future's potentially not too bad over the next 12 months to 2 years, and get out and get a few more people on board.
Rod, good to talk to you. Thanks so much.
Thank you.
Thank you.
OK, let's go to sport now. Here's Sherelle.